Welcome to your first case. This is Blackheath Manufacturing Company. To get us started, I'll have you open your book to page 5, which is the first page of the case. So the case is pages 5 through 8 in your book. It's fairly short, but it's jam-packed full of great information. So I'd like to start on page 5 and just briefly talk about some of the tables and kind of how to guide your thinking about the numbers that you see here, and some of the challenges that you're going to be facing to solve the case and come up with the right conclusions to the questions that are asked in the Excel template. So just a review again of what you have for materials. You have this video. I would start with this, of course. And you have the Excel template that I created. That template guides your thinking through the question. So there's structure there built into the templates and checkpoints as well as little hints to help you obtain the answers and to guide your thinking. So I think you'll find those very useful. And then also you've got a handout, a workbook, generally is a couple pages long. It has a list of the terms, so I've kind of compiled that for you, a list of the terms and critical equations for the case, as well as links to other YouTube videos if you wish to expand. If you have the time to really dive in deep on the topics, then those are optional learning materials that are there for those of you that feel like you need a little bit more backdrop for understanding some of the moving pieces. So on page 5, first thing I want you to look at is right at the very beginning, after the first paragraph, there's a table of numbers. And what you see here is week 1, 2, 3, and you see the first column of numbers is units of output. So we have 400, 500, 600. So we know that we can produce up to 600, and we do know that other weeks we aren't at that capacity. We don't know exactly what full capacity is for this company, but we do know that they produce as much as 600 in some weeks. And so the first 2 weeks we weren't at that level. So we weren't at full capacity, or at least 600. All right, and then you notice there's materials and labor, and both of those dollar amounts increase for week 1, 2, and 3. And you would expect that if we're selling more units of output, we would require more units of material. So you would expect that to vary in response to the volume changes in output for both materials and labor. You're also seeing some increase with indirect labor as well, but not with indirect materials. So the indirect materials is 300 no matter what the level of output is. So we'd say those costs are fixed. There's no variation with regards to sales. Okay, so that's the first one we hit, that's fixed. The next one looks like it varies to some degree, but not at the same proportion, right? So that's how you know whether something is mixed, meaning that it has a component of fixed and variable in it, when it changes at a different proportion than the change in volume, right? So you would look for the percentage change to determine whether or not it's 100% variable, meaning it moves in direct proportion to volume, or whether it's a smaller slope, right? It's not moving in direct proportion. And there's a way to test that, and if you look at the Excel template, I did a whole bunch of scatter graphs for you to help you figure that out. And so I'll talk more about that here in a minute too when I review the scatter diagrams and how to create them. So hang in there, we're not done with this. All right, the factory insurance notice does not change. It's $125 no matter what level of activity or volume that we're at. So again, that one would be considered fixed. Right? The dollar amount does not change relative to volume. And then other overhead increases. So again, we need to figure out whether there's any fixed component that's embedded in that, and again, it depends on the rate of change of the cost relative to the rate of change of the volume. And as I said, it's easy to sort that out when you do a scatter diagram. So those are some of the cost components that we're going to contend with, and the way they behave matters, right? The way they behave matters. And it also affects our unit costs. All right, so let's look at the numbers down at the bottom of page 5. You got income statements for week 1, week 2, week 3. And so if you want, in pencil, right above week 1, that the units there are 400, right above week 2, the units there are 500, And right above week 3, the units there are 600. And notice what's happening to net income. So we're going from a negative $91, or losing money at 400, to making money $259 at week 5, and then really moving forward at 600 units. We're making $609. That's quite a jump from 500. And it should occur to you that it's not proportionate, meaning that the increases in net income are increasing at a much faster rate than the increases in the units. And the reason for that is because some of the costs don't change. Some of the costs are fixed relative to changes in volume. So as your volume increases, you're really able to retain the amount of money that you're making on the additional units that you're selling. And so what I'm really getting at is what's break-even point, and at what point do we really start making money on our products? Obviously, from looking at these 3 columns of numbers, break-even point, which is where profit net income equals 0, is somewhere between 400 and 500 units. And you're going to calculate that in this case to figure that out. All right, then on the next page, page 6, you notice that there's useful numeric information in the middle of the page. And they have determined that the units cost $6.60 a piece. However, that's based on sales of 500 units. So that becomes a little bit of a problem if volume is moving around significantly beyond that value of 500. And we have seen that it is, right? So it's been as low as 400 and as high as 600. So if you're taking those fixed costs and you're dividing by 500 units, you're going to get the values you see here on the page. But if you divide them by 600 units, obviously those numbers for the fixed costs would go down on a per unit basis. That is a problem for managers. It's a very common problem. It's a mistake that a lot of people make when they think about unitized fixed costs. So you have to be super careful about unitizing fixed costs. It's okay to unitize variable costs because variable costs vary on a per unit basis. So you can isolate that change and it's accurate and it's not going to move on you. So for instance, the first item, average variable cost per unit produced is $2.80. It will be $2.80 if you're producing 400, 500, or 600, okay, because it varies with sales. So that is a good number. You can depend on it no matter what the volume is. However, the next one, average fixed cost per unit produced is $1.42, is based on taking the total fixed cost and dividing it by 500, because in the paragraph right above it says that they're basing it on 500. So if production is different than 500, then that number is not stable. It's going to go up or down depending on whether production goes up, in which case that value would go down, or production goes down, that value will go up. It's more expensive if production is less, because you're spreading out fixed costs over smaller units. So you got to be super careful about the fixed cost ones. And you've got a couple of them in there. So you got the $1.42 is fixed, so it's a red flag. And you got the average fixed administrative and selling cost of $1.56. So you've got 2 of them in there that can change, right? So when they make pricing decisions to set the price at a certain percent, which they talk about in this case, a certain percentage above the total unit fixed cost of $6.60, which is given right there on the middle of the page, that's a very slippery slope to be on. So if you're going to make statements like that and your production isn't stabilized like this company, which is very common, especially if you're a young firm and you're growing and you haven't stabilized your production yet, then you probably should be basing your decisions on just the variable costs. So figuring out what that markup has to be on variable costs. A lot of companies use what's called variable costing for that exact reason, because they don't want to get tripped up using the unitized fixed costs, which can be a very slippery slope, like I said. All right, so that's one of the key takeaways from this case, is that you get an understanding of how to use unitized costs when to use them, how to use them, what kind of red flags to look out for in terms of unitizing those costs, and when you can depend on those numbers and when you have to be very cautious about using them to set things like prices. Okay, so then the company, they do set some decision-making rules based on that $6.60. And they say that it's got to be at least $7. They work their way, after you read through the case, you'll see that they land there. They're going to sell them at $7 a unit. So they think they're going to make roughly 40 cents a unit if they sell at $7 a unit. And they tell the folks that work there that if they sell below those prices, there's going to be problems. Okay, and one person actually gets fired for selling below those prices. So one of the things you have to do is figure out if those, what we call special orders, should have been accepted, or if it was okay to reject them based on their decision rule. And you got to figure out what's the relevant data in making that decision. So the general thinking here is that if you make enough on a sale to cover your variable costs, then that sale will generate profit that goes towards covering your fixed costs, which, remember, are fixed no matter what volume you're at. So that's what this case is attempting to do, is get you to wrap your mind around how that works, how you treat fixed costs and variable costs. So let's go ahead and look at some of the case aspects here. Go to the next slide. A few slides. So this is just a summary, right? So this employee, Lee High, he's the cost accountant for Blackheath Manufacturing, developed a set of decision rules for pricing the company's product line. His recommendations were based on an analysis of total average unit costs, which means average unit variable and average unit fixed. So you see that there on page 6. Based on his recommendations, the owner of the firm shared these results with the sales representatives and stipulated that the price would be set at no less than 10% above the full cost to deliver the units. Okay, so that would have been $7.26, and you'll notice in the case that they decide they can't really price these products above $7, or they just won't sell. So competitive pressures are limiting how high they can raise their price. Continuing on, unfortunately, one of the file clerks sold below the stipulated requirement and was fired. So your job is going to be to determine whether or not the analysis that Lee had done to get the 660 unit cost is correct. And if you decide that he's made some errors, you've got to come up with some new rules for them. Okay? Go to the next slide. Okay, so these are the learning objectives that I have for you. So I do want you to get your mind wrapped around some of the terminology. You'll see some of those things in the case as well as in the handout that I gave you, so make sure you read through those. And then creating scatter graphs. So I've given you several in the case template, in the Excel template. I've done them for you. And then I asked you to do one as part of your assignment that's got 2 data points in it. By the way, anything you ever wanted to do in Excel, you can find a 5-minute video on YouTube that shows you how to do it. It's really incredible. And I also will give you some little tutorials. You also are required to calculate variable cost per unit and total fixed cost to determine break-even point. So notice that I didn't unitize the fixed costs here, right? And that's on purpose, because it's, like I said, it's a very slippery slope to do that. So I generally don't recommend unitizing fixed costs. Go with variable costing and base your decisions from that. All right, so to do that, we set up what's called a contribution margin income statement. And contribution margin is calculated as the price minus the variable cost. So you figure out how much each unit contributes to, accounting is like that, it always has a word embedded in the title. How much does each unit contribute to covering fixed costs? And we're basing it on the idea that we have excess capacity. And finally, if you look at the last page of the case, it's very interesting. you're evaluating an incentive compensation system. So the owner thinks that he'd like to sell the product, even though they've told him that they can't get more than $7 a unit. He's willing to sacrifice volume and get more per unit. So he says, if you can get $8 a unit, we'll give you a 15% commission, sales commission. And he bases his analysis there on the total costs that are calculated in on page 6, where it's based on 500 units. So those costs are based on 500 units. If we charge $8, the volume's going to go down significantly. And he does say that. He says volume will be 350. So to use those unit costs is incorrect. And this is what I was talking about in the introduction video. You have to learn how to create the information that you may need. So you need the accuracy in your information to ensure you make the right decisions. You need to understand what and how the information is calculated and whether or not it's appropriate to use it under certain circumstances. So in this case, he's basing an $8 price on a volume of 350. You'd have to go back and recompute the average fixed cost at 350, which would go up significantly. So the numbers that he's citing here, $315 profit per week, is not correct. That's incorrect information. You've got to sort that out. So I recommend you just do a contribution margin income statement instead and figure out what that profit would really be at that level. So you can do that. And then notice for the $7, he's saying at $7 the volume would be 450. So again, you still have the same problem because those costs per lease chart were based on volume of 500, and you can't include the fixed costs at the unit price at 500 units, based on 500 units, and apply that to the situation at different volume. It just doesn't work. And so this is a great example of how you got to have the correct, accurate information to drive the decisions you need to make. So I want you to rerun those numbers based on what you understand using contribution margin income statement to do that. All right, so here's the scatter diagram thing. So what a scatter diagram does is give you an observation. So it's a coordinate. Remember that from your math classes. It's a coordinate. So it's pairing up a y value and an x value. So in this case, the y value is going to be the cost, and the x value is going to be the volume. And so every dot on the graph is a pair. So in other words, at a volume of 400, what's the direct material cost, right? At a volume of 600, what's the direct material cost? And there's a dot on the graph. So a scatter diagram is a plot of coordinate values that occur for various account categories. Obviously, using the formula for a straight line, which is what we're going to use. This is your intercept, and with intercept hitting the y-axis, that indicates that that component would be your fixed cost. So if you're looking at data and you calculate the intercept and it's 0, that means that that cost does not have any fixed components to it. It's 100% variable. Whereas if it has a b value or an intercept value, that b value is the fixed cost that's embedded in that cost equation. And then the m value is the slope, so the change in the total cost relative to units. So that m is actually what your variable cost per unit. So notice even the equation for a straight line doesn't unitize the fixed cost, but it does unitize the variable cost. M is the cost, variable cost per unit. B is a total fixed cost, not unit fixed cost, total fixed cost. And that pairs itself very nicely with how we set up our contribution margin income statements and analyze costs. So study that tab in the Excel sheet where I show you how to do those scatter graphs and walk you through the various steps that you would take to create one. And again, if you really need some help creating a scatter graph, if you just quickly Google YouTube video on creating a scatter diagram, you can find a 2 or 3 minute video that's better than I could create. So don't hesitate to do that if you need some help. Your formula for break even takes total. So again, notice we do not unitize fixed costs. Total fixed costs in the numerator and divides it by the contribution margin per unit, which is calculated as the price minus the variable cost per unit. So that formula will give you the break-even point. You'll have that in the Excel template. So you can figure out exactly how many units do we need to sell to break even, so you know what that tipping point is. And we already know it's somewhere between 400 and 500, given what we see on page 5, right, for those income statements. Okay, so that's just general thinking there in terms of your scatter diagrams. So I talked to you about this already. Lee uses an average unit cost figure, and is it appropriate? And the answer is that it's only appropriate if all of the costs are variable. So in other words, if you've got any fixed costs per unit in there, be very careful. Go red flag. So they do have fixed costs, and the average cost will decline as more units are produced. And I have you run through that and calculate that break-even price at different volumes. For short-term decision making, it's best not to unitize fixed costs. Like I said, most companies just use variable costing and don't bother unitizing fixed costs. So as a general rule, any price above break-even would give them long-term sustainability, and they should strive to reach a reasonable profit margin over time. In the short run, which is the decisions that they're making in the case, is short-term. We got a special order that's come up right now, we need to make a decision on it. Any price greater than the variable cost per unit would add profitability to the bottom line, and if excess capacity exists, which we know it does most weeks, the order should be accepted. So that's going to be your general rule of thumb. Okay, and like I said before, you got that incentive compensation in the form of sales commission at the very end on page 8. You got to analyze that, so recompute those profits because he's got it wrong, and see what you think about that. Okay, I look forward to working with you on this case. No problem.